the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin. It's Father's Day this weekend, and on today's Wealth Tracker, we're flipping the script. We're not just talking about money, we're talking about the wisdom behind it. The kind you'd want to pass down to your kids, not just in a will, but in a conversation, perhaps over dinner, or maybe even a letter. Today, I'm joined by someone who's done just that, Steve Brice, Global Chief Investment Officer at Standard Chartered. But this isn't just another CIO outlook. This is a dad who guided his sons through their investment journey, as highlighted in his piece, Diary of a CIO's Son, Straight from the Heart. So whether you're a parent, a young investor, or just someone who wishes they've gotten that money talk earlier in life, pull up a seat, because today, Steve isn't just speaking to his sons, he's speaking to all of us. To find out more, joining me now is Steve Brice, Global CIO of Standard Chartered. Steve, welcome back to the show.
Thank you so much. What an introduction. So kind.
Thank you so much for joining us, Steve. Now, Steve, in your piece, Diary of a CIO's Son, you wrote about the investment advice you gave to your son as your youngest just started out on his investment journey last year. And you wrote another one about your eldest son recently. But, today we'd love for you to speak to all of us as if we were your sons and daughters. So let's open that investment diary and learn together. So first question, what's the number one first lesson you passed down to your youngest son?
I think the first thing that I was very keen to sort of indicate was investing is as much, if not more, about managing your emotions as it is about trying to think what's going to happen in markets and what returns you might make. So just realizing that, and we've obviously seen that very much this year, that we get volatility in different asset markets and in different investments, and how you relate to those movements is really, really important. So that's where managing your emotions comes in first and foremost.
Well, in terms of allocation, you and your youngest son discuss what his target allocation for equities, bonds, and gold should be in 2 years' time. Now, I believe he decided on a 75% to equities, 15 to 20% to bonds, and 5 to 10% to gold. Was that a good starting point in your perspective?
Well, I think the first, which was the in 2 years' time piece, that was really just to sort of say, let's take the emotion out of this. You don't have to do everything today. So, that is just sort of saying, okay, ideally that's where I want to get to. Now it's much easier than to say, okay, let's plot my path to getting there. So that was the starting point. And then really where he ended up, is really coming down to learning about himself. And we did a lot of, looking at charts of different performance and max drawdowns and stuff like this. And he got a sense of what he thought he might be comfortable in losing in any given period of time, with obviously the upside over a longer period of time. It really comes down to the proof of the pudding is in the eating, though, of course, right? So he's still relatively early on his investment journey. I had no indications that he's worried about markets, so maybe he's got it right.
Oh, okay. So how should one then select the right target allocation? Is there a rule we have to follow, or is it really entirely up to the individual?
It is up to the individual, but I think, the starting point obviously is that if you look at, you want to be diversified across different asset classes, but we know that equities will outperform bonds over very long periods of time, but they also come with extra volatility or drawdown risk, so the risk of temporary loss. So theoretically, if you're looking 10 years out, you should probably be close to 100% allocated to equities, but your emotions get in the way of that. So if you know that equities at some point in an economic cycle will probably lose 40 to 50% of their value. So if that's going to be something that scares you, even if you have a pretty good indication that you're going to do well over a 10-year time horizon, then probably that's where you start tilting and saying, okay, I need some bonds in there as well. So it's just really just trying to get that calibration right of maximizing returns, but at a risk that you're comfortable with.
Okay. Well, after setting up the targets, now the practical question here is, how do you go about investing the money, right? So the key here, I believe, of course, is diversification. But how do you choose what to invest in, Steve? I mean, how do you know whether you would go through active management or passive investing?
So as you say, diversification is a starting point. So that's by different asset classes, which we've just discussed, bonds, equities, maybe some gold in there as well, but also across geographies. So, and we can talk about that when we come to my eldest son, because he went a slightly different route to start with, at least. And you don't need to overcomplicate this. So I think, a lot of people will say, okay, well, I need an allocation to US equities, European equities, Asian equities. Okay, so that's 3 investments I need to make. What about bonds, etc.? You can do this really quite simply, especially when you're starting out. You can do it. You could either do one global equity fund or one bond market fund, at the global level, or you could just do one fund that does cross assets. So it really is quite, days it's pretty easy to get started, and of course you can learn as you go along and make tweaks to that process. In terms of active versus passive, the way we approach this is just saying we want the best return after taking into account fees. So if you're paying a fee for an active fund, then you want to be pretty confident that that's worthwhile paying. And in the bond space, that's usually actually quite easy to achieve. In equities, particularly developed market equities, it's a bit tougher. But again, don't need to overthink this too much. Being invested is far more important than analysis paralysis about whether you go active or passive.
Okay. And the key thing for you was, despite your son being an 18-year-old when you had this conversation with him, was that he made all the decisions. Why was that a must for you? Why was that decision crucial?
It comes down to accountability, because if I directed them to do something, then it would have been on me. Mm-hmm. And I didn't want that. I wanted them to do it. And it's okay. We're not talking huge sums of money, right? They're still at university. They were gifted a relatively small amount of money to invest. So if they lost everything, they'd learn a lot. And the way we sort of looked at it was saying, okay, that's part of an education bill if that was to happen. So it really just important that they own their successes, and they own their failures. And that, I think, if you do it like that, they're more likely to learn the lesson than if they've been directed to a certain outcome.
Makes sense. So how has your son's investment journey been so far?
It's actually been pretty quiet, so I'm assuming it's going okay. So he decided to invest in 3 tranches. Mm-hmm. So he did one straight away. I know he did a second one. So I still think he's got 1/3 to go. I think actually the key thing for him is what he's probably learned about himself is he doesn't check his portfolio every 5 minutes, which means maybe he could actually take a little bit more risk than he has done, but 75% in equities is still quite decent. He seems pretty good.
Okay. Making you proud. Well, meanwhile, based on your part 2 of your Diary of a CIO's Son, Steve, your eldest seems like an entirely different path. What does this say about how every investor's journey is different?
I think what was quite interesting was the slightly different approach, or the way that they looked at it. So I think my youngest was more thinking he's an emotional person and he wanted to understand exactly what he's getting into. The older one was much more academic about it, and so it was like, okay, I'll maximize my returns by being in equities, so that's what I'm going to be. So I think it really does mean that you just need to understand your strengths and you need to understand your weaknesses, and you need to learn as you go along. But yeah, everybody does have a different journey, but that's fine. So
what's one key takeaway your eldest son took from your investment tips?
So as I said, he started out by being 100% in equities. The rationale was very rational. It was basically saying, well, I'm not going to need this money for 10 years, and therefore, equities will outperform most likely on a 10-year time horizon. And I'm not going to be looking at it on a daily basis, and the valuations on a daily basis, and therefore the volatility won't affect him. But I think what he learned was, actually, he does look at his portfolio quite a lot. So he got quite excited. He did really well to start with. So he's up quite strongly to start with. But when equities fell sharply, so actually even before Liberation Day, so from mid-Feb to mid-March, so we saw about a 10% drawdown, he rang me and said, should I worry? So he learned that actually, while he theoretically knew that this was a good thing to do, he actually felt maybe I got it a bit wrong and I do get worried. So he's really sort of now realized the emotional side to this, and so he's taken actions to address that.
Okay. Well, despite the different journeys between your 2 sons here, did they get the same outcome from their investments?
They're getting closer, obviously. The youngest, as I mentioned, has invested about 2/3 so in a diversified portfolio. I think the eldest one started with 100% in equities, but now has added some bonds, so sold some of the equities to invest in some bonds, and also diversify. He was 100% into US equities, so he bought some European equities. So not at the same outcome by far, but they're getting closer, and I think over time they will converge.
Okay. Well, is there one question that your sons have asked you that made you realize, oh, that's a good question that you'd like to share with us as well and help us answer it?
So I guess one of the questions was the concentration you can take by investing in different markets. And so there were two levels of that. One was global equities. We know that the US allocation in a global portfolio is at all-time highs. And then also, if you look at the concentration risk in the S&P 500 towards tech companies, for instance, is very high as well. And obviously in the Mag 7, the youngest son was very keen to understand what that meant. So there was always the response, technology is the future, so isn't that good? And said, yeah, but then if one of those companies does poorly, then that will have an outsized impact. So he was talking, actually, part of his portfolio is what we call the S&P equal weighted, which basically doesn't look at it from a market capitalization perspective, but gives an equal weight to each of the stocks. And that was to try and mitigate that concentration risk.
Okay. Now, if we were your children just starting out, maybe first job, first paycheck, how would you guide us on setting up our first investment plan?
So the first thing to do is to start as early as you can. Obviously, when you're getting your first job, often money is quite tight. I mean, if you're living with your parents, maybe that's less of the case. But, just start with regular investments. I would go very simple. So maybe look for a cross-asset fund to start with and just invest every month or every quarter. And I think the key thing there is to sort of think about whether when you're talking about your allocation to equities, is 80% right for you, or is 60% right, or 40%, and maybe try and guess what that might be to start with and then learn about yourself. I personally would go with less risk appetite to start with until you get comfortable, especially if you're a bit nervous about going that route. But you can do it either way, and hopefully you'll find your way and understand your emotional journey.
All right. Well, then what do you hope your sons remember more? The big investment wins that he's made, or the principles you've taught him to live by?
I think that obviously the principles are really important, right? Because that's what's going to stand the test of time. So definitely the principles that they've learned. It's not that necessarily I've taught them, but they've learned along the way, I think are going to be really important for them.
All right. Now, if every listener today could walk away with just one mindset shift you gave your sons, what would it be?
I think it would be that most people who are investing are trying to predict markets, and that's incredibly difficult. Obviously, a big part of my job is trying to do that. But, we have a lot of resources at our hands that most people don't have, and we obviously do it for a living, so we have a lot of time dedicated to it. And even then, it's not easy. So I think the key thing is to say your relationship with gains and losses is far more important than trying to predict markets. Markets will rise and they will fall. Predicting exactly when is difficult, but you need to be pretty confident in how you will react in different environments and make sure that's not going to be detrimental to long-term returns. So really, it's all about you more than markets.
Well, we've got some great investment advice from you here. But ahead of Father's Day, Steve, since we can't all have a global CIO as a father, what would you say to all the fathers listening who are trying to raise financially savvy kids?
So I guess the key is to start early, and I think there's three potential steps to think about that. So one, as we all know, teaching kids the value of money is difficult but really, really important. So if people can learn about earning, saving, and investing, and also spending in a disciplined manner, I think that is really going to be very helpful to setting the starting point. The second point is to help them understand there's a trade-off between enjoyment today and security and enjoyment tomorrow. So that's something, again, if we can, one of the key things that is always said is you can predict somebody's success by how they are able to defer enjoyment. So, if, for instance, give them one sweet now, or two sweets in 20 minutes' time. If they choose the one sweet, they're less likely to be successful than if they choose the deferred bigger option. So if we can give them that trade-off, I think that's useful. And then the third piece is, I come back to this, investing doesn't have to be overcomplicated. Simple and disciplined will outperform complex and ill-disciplined over the long term.
All right. Some great advice from you there. Thank you so much, Steve, for joining me, and happy Father's Day.
Thank you so much, Hongbin.
Thank you. That was Steve Brice, Global CIO of Standard Chartered. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.